Ever wonder why a stock price might drop even when the business is actually exploding with growth? Today, we are diving into the Shriram Finance Q3 FY26 results to uncover the truth behind the numbers and why this reported profit dip is actually a massive growth signal in disguise. Let's look at the core numbers. Total income is up nearly 14% year over year, reaching 12,191 crore, driven by strong core lending. Assets under management expanded by over 14.6% to hit a staggering 2,91,709 crore. Most importantly, asset quality is improving, with gross NPA dropping from 5.38% down to 4.54%. Now, let's address the elephant in the room, that 29% drop in reported profit. It is actually headline noise caused by a high base effect from a one-off housing finance sale last year. If we normalize the data to show true core profitability, profit actually grew by over 21%, with current PAT at 2,521.67 crore. Top-line strength remains robust. Total income grew by 13.88%, with interest income acting as the primary driver. Thanks to efficient liability management, the cost of funds only grew by 10.69%, which is lower than income growth. This protected margins and pushed operating profit up by 14.33% to 4,670 crore. Scaling the loan book is a major highlight here. In a tough macro environment, Shriram delivered double-digit AUM growth of 14.63% year over year. This brings their total asset base to over 2,91,000 crore, showing they are successfully capturing market share despite economic headwinds. The business is firing on almost all cylinders. Commercial vehicles remain the backbone, making up over 45% of the total book. However, the real momentum is in passenger vehicles, which surged nearly 22%, and MSME loans, which grew over 18%, as small business traction remains strong. It wasn't all green, though. Construction equipment is currently the weak link in the portfolio, showing a 20.39% year-over-year decline. While this segment is a drag on performance, it only represents about 5.27% of the total portfolio, so the overall impact is limited. This quarter marks a structural pivot to quality. We're looking at the cleanest books in recent history, with gross NPA falling to 4.54% and net NPA at 2.38%. They've also hiked their provision coverage ratio to 48.77%, adding an extra layer of safety for the future. The balance sheet is currently overcapitalized and extremely safe. Their capital adequacy ratio is at 20.27%, well above requirements, and liquidity coverage is exceptionally high at 334%. With a stable debt-to-equity ratio of 4x, there is significant room to grow without needing immediate equity dilution. A massive catalyst is on the horizon: the 39,617 crore strategic investment from MUFG Bank. This massive preferential issue will massively bolster the capital base, providing the dry powder needed to fuel the next leg of aggressive expansion. Shriram is also building a digital moat with their Shriram One super app. It's already reached 16.4 million net installs. This isn't just a shiny tool. It actively supports lower-cost customer acquisition and makes digital loan collections much more efficient. Of course, every investor should watch the risk radar. Key things to track are the cyclicality of the commercial vehicle market, which is 45% of their exposure, potential cost inflation from new labor codes, and interest rate volatility that could eventually squeeze margins. Running through the investment checklist, there are no red flags in cash conversion. The one-off impacts from the housing finance sale are clearly separated, and leverage remains stable. The only cautionary note is a sharp increase in employee benefit expenses. The verdict? This was a constructive quarter. While the headline profit drop looks scary, the underlying reality is 21% profit growth and 15% asset growth. With asset quality at its best and new capital pending, the foundation is set for aggressive future growth. Did you find this breakdown useful? Make sure to like, save, and subscribe to ZinvestZ for more such quarterly breakdowns and smart investing insights. Thank you.